welcome to Economics with Mekala. Today's lesson is about market bubbles, and in this lesson we'll be discussing about speculation and moral hazard. What is speculation? Speculation is when investors or consumers aim to buy or sell products like stocks, currencies, or any other forms of assets now to make quick profit, expecting higher returns from those investments in future. For an example, if someone is buying gold today expecting there will be higher prices for gold in next month, that is a behavior from a consumer buying more gold today expecting higher prices in future. And if this consumer is selling his gold he purchased last month for a higher price, he is making a quick profit. So speculation can influence markets significantly. If you look at a market bubbles are resulting from due to speculative motives of consumers. Market bubble is a bubble which exists in the market when the price of something is driving well above the fair prices it should be. Let me example this term using a very good example for a market bubble is Tulip bubble. The Tulip bubble appeared in the market in 1634 and it collapsed around 1637. So during the ancient times even we could witness market conditions like market bubbles. If you look at what happened at that time, there was demand for tulip flowers in the market and the prices of tulip flowers were increasing rapidly due to the rising demand. So many people started growing tulip flowers in their gardens or in their farms expecting very high prices in future. So as a result, you can see in the graph, prices of tulip flowers increased significantly by 1636. But at one point, some consumers or some buyers or sellers lost confidence about buying tulip flowers for very high prices. As a result, the market collapsed. This is what is happening in a market bubble. When consumers are expecting very high returns out of their investments, they keep on investing, buying or selling that product in the market. Due to the rising demand, the prices of that product also increasing. That creates a market bubble. But at one point, when consumers, buyers or sellers lose their confidence, they stop trading these products for higher prices. That can influence other buyers, sellers in the market. So when people stop trading tulip flowers for a very higher price, the bubble was bursted. As a result, market collapsed. If you want to look at more examples for market bubbles, you can look at Dotcom Bubble and Bitcoin Bubble. The Dotcom Bubble was in the US, and what happened due to the rising popularity of internet, there were many ventures based on electronic commerce. So there were many companies, new startups. They were all electronic commerce businesses. But the demand for electronic commerce businesses were increasing rapidly, and as a result, after some time, the market for electronic commerce businesses suddenly collapsed. That was the bursting point of the market. And nowadays, people discuss about Bitcoin bubble. Bitcoin is a virtual currency, and if you look at the graph I'm sharing with you, from 2011 to 2017, the prices of Bitcoin, the value of Bitcoin has increased significantly from $1,000 to $3,000. But this is solely done by the speculation and rising demand from consumers who are purchasing Bitcoins. Why we call a Bitcoin marketer market bubble because if you look at the size of this Bitcoin market and the value of Bitcoin market, that has become the largest valued market in the entire world. If you consider the net worth of Bill Gates, the size of the value of Bitcoin market is 2 times his net worth. If you take the total value of gold in the world, that should be multiplied by 200 to match with the value of Bitcoin market. That shows the speculative initiative taken by many users of Bitcoin. They keep on buying more Bitcoins, expecting the prices will increase more and more in future. But economists and financial market experts are proposing that stop purchasing Bitcoins at very high prices now because this is like a market bubble. At any time, this bubble can burst. Moral hazard. What is a moral hazard? If you look at economic agents, they make economic decisions. But when they make economic decisions, they know there are adverse effects, negative consequences. But ignoring them, they still make those decisions because they know these consequences are paid by other economic agents. Very good example for moral hazard is housing bubble collapsed in 2007 in the United States. Around 2006, starting from 2005, the housing market was rising rapidly in the US. That was due to the rising demand for houses and rising house prices in the US. But as a result, the market was growing very fast and it collapsed around 2007. When the market collapsed, what happened actually? The government had to give 900 billion US dollars loan to mortgage markets, financial markets, and housing market companies to recover from that. So knowing that housing market was showing characteristics of a market bubble, they started growing the market. Buyers and sellers involved in speculative transactions. As a result, market collapsed, but adverse effects were paid by the government. So mostly investors or businesses take some economic decisions knowing that there are negative consequences, and they do take these decisions because they know their negative consequences are paid by the government or any other economic agents in the society. This is a past paper question. This was a 4 marks question in your Unit 1 paper, Section B. In the European Union, if a bank fails and has to close down, an individual's deposits are guaranteed up to 100,000 euros by the individual's government. With reference to the market for banking, explain what is meant by the term moral hazard. So if you look at this question, this is a 4 marks question. So for defining moral hazard, you get 2 marks. And applying to the banking sector, which is the case study in this question, you get another 2 marks. So knowledge 2 marks and application 2 marks. Let's have a look at how can we write a complete answer for this question. Let's define moral hazard. So moral hazard is occurring when economic agents make decisions knowing that there will be adverse effects, but those will be borne by other economic agents. So institutes like banks would act immorally, focusing on their profits and issue more risky loans to customers. For an instance, in European Union, banks shall take more risky investments, knowing that customers' deposits will be protected up to 100,000 euros by the government. So if you write your answer in this format, including these points, you will be receiving 4 marks for the complete answer you have written. Thank you for watching this video, and please stay tuned for upcoming videos from different topics from your Unit 1 microeconomics lessons. And if you enjoyed this video, do not forget to press the like button, and if you have not subscribed to my channel yet, please subscribe. Thank you very much for watching this video.